Starting a small business can be tough, especially when it comes to money. Did you know that 82% of small businesses fail because of cash flow problems? That's a shocking number. But here's the good news. There are many creative ways to finance your business beyond traditional loans. In this video, we're diving into 18 unique financing strategies. Forget about waiting for bank approvals or stressing over high interest rates. We'll explore crowdfunding, where one company raised over $20 million in a single campaign. We'll uncover the world of peer-to-peer lending, which has saved businesses up to 4.8% in interest rates compared to traditional loans. Ever heard of revenue-based financing or microloans? These are game changers for many small businesses. And what about turning unpaid invoices into cash or bartering services to save money? Yes, these are real and effective strategies. We'll also talk about how to attract angel investors, win grants and competitions, and even use business credit cards smartly. Each chapter is packed with tips, real-world examples, and actionable advice. So, if you're ready to unlock new financing options for your business and keep your cash flow healthy, stick around. These strategies can transform your business and give you the boost you need to succeed. Let's get started. 1. Crowdfunding craze, turning public support into cash flow. Crowdfunding has taken the world by storm. It's like a virtual megaphone that amplifies your business idea to millions. Platforms like Kickstarter and Indiegogo are goldmines for small businesses. Did you know that PebbleTime, a smartwatch company, raised over $20 million on Kickstarter? That's the power of the crowd. But it's not just about posting your idea and hoping for the best. You need a killer pitch video and compelling rewards. People love feeling part of something big. Offer them exclusive access or limited edition products. Here's a tip: build your community before you launch. Engage with potential backers on social media. When your campaign goes live, they'll be ready to support you. According to Crowdfunding Insider, campaigns that raise 30% of their goal within the first week are more likely to succeed. It's all about momentum. 2. Angel investors, attracting wealthy benefactors. Angel investors are like business-savvy fairy godparents. They're wealthy individuals looking to invest in promising startups. Remember, they're not just bringing money to the table. They offer valuable advice and connections. Finding the right angel investor is crucial. Look for someone who shares your vision. Pitching to them can be daunting, but if you believe in your idea, your passion will shine through. According to the Center for Venture Research, angel investors in the U.S. invested $25.3 billion in 2020. That's a lot of potential funding. A good strategy is to attend networking events and pitch competitions. Don't be afraid to reach out directly. Many angels are more accessible than you think. As the saying goes, if you don't ask, the answer is always no. 3. Revenue-based financing, growth without giving up equity. Revenue-based financing, RBF, is a game changer. Instead of giving away equity, you repay investors with a percentage of your revenue. It's flexible and scales with your growth. If your business thrives, you pay back more. If it slows down, your payments do too. This model is great for businesses with steady revenue streams. Lighter Capital, a well-known RBF firm, has funded over 350 companies this way. One interesting fact is that RBF doesn't usually require personal guarantees or collateral. This makes it less risky for entrepreneurs. According to data from Lighter Capital, their clients see an average growth rate of 40% year over year. 4. Peer-to-peer lending, harnessing the power of community. Peer-to-peer, P2P, lending connects borrowers with individual lenders through online platforms. It's a modern twist on traditional lending. Platforms like Lending Club and Funding Circle have made it easier than ever to get funded. One of the best parts? P2P lending can often provide better rates than traditional banks. A study by Fundera found that small businesses save up to 4.8% in interest rates using P2P loans compared to traditional loans. It's also a faster process. Traditional loans can take weeks to get approved, but P2P loans often take just a few days. Just be sure to have a solid business plan. Lenders want to know they're investing in a viable business. 5. Microloans, small amounts, big impact. Microloans are perfect for startups and small businesses that need a little boost. These loans typically range from $500 to $50,000. Organizations like the SBA and Acción offer microloans with favorable terms. Despite their small size, microloans can make a huge difference. A report from the Aspen Institute found that 56% of businesses that received microloans increased their revenues. Microloans are also more accessible to businesses that might not qualify for traditional loans. They often come with added benefits like business training and mentoring. It's a holistic approach to supporting small businesses. 6. Invoice factoring, turning receivables into immediate cash. Invoice factoring lets you turn unpaid invoices into immediate cash. You sell your invoices to a factoring company at a discount. They handle the collections, and you get the cash flow you need. This method is especially useful for businesses with long payment cycles. According to the Commercial Finance Association, factoring is a $3 trillion industry worldwide. One key advantage is that factoring isn't a loan, so it doesn't add debt to your balance sheet. It's a quick solution to cash flow problems. Just be sure to choose a reputable factoring company. Look for one that offers transparent terms and competitive rates. 7. Equipment financing, getting what you need without the wait. Equipment financing is a smart way to get essential tools for your business without breaking the bank. Instead of paying a lump sum up front, you can spread out the cost over time. This keeps your cash flow healthy while you grow. One unique aspect of equipment financing is that the equipment itself often serves as collateral. This reduces the risk for lenders and can make it easier for you to get approved. According to the Equipment Leasing and Finance Association, over 79% of U.S. companies use some form of equipment financing. A good strategy is to compare different financing options. Look at the interest rates, repayment terms, and any additional fees. It's also worth considering leasing options. Leasing can be more flexible and may include maintenance and upgrades. 8. Merchant cash advances, fast funds for high sales businesses. Merchant cash advances, MCAs, provide quick access to funds based on your future credit card sales. They're a popular option for businesses with high daily sales volumes, like restaurants and retail stores. The process is straightforward. You receive a lump sum up front, and the lender takes a percentage of your daily sales until the advance is repaid. This means your payments fluctuate with your sales, making it easier to manage during slower periods. However, MCAs can be expensive. It's crucial to understand the total cost of borrowing. According to a study by Harvard Business School, the effective APR for MCAs can range from 40% to 350%. So, use them wisely and only for short-term needs. 9. Business credit cards, flexible financing for daily operations. Business credit cards are a versatile tool for managing everyday expenses. They offer flexible financing and often come with rewards programs that can benefit your business. One key strategy is to choose a card that aligns with your spending habits. If you travel frequently, look for a card with travel rewards. If you make a lot of purchases, find one with cashback benefits. Business credit cards also help build your business credit score, which can be beneficial when seeking larger loans in the future. According to Experian, 59% of small businesses use credit cards to finance their operations. Just be sure to pay off your balance each month to avoid high interest charges. 10. Grants and competitions, free money for innovation. Grants and competitions offer free money for your business, but they're highly competitive. The key is to find grants that align with your business goals and to craft a compelling application. There are many sources of grants, including government agencies, private foundations, and corporations. For example, the Small Business Innovation Research (SBIR) program awards over $3 billion annually to small businesses engaged in R&D. Competitions can also be a great way to gain funding and exposure. Events like the MIT $100,000 Entrepreneurship Competition and the Hulk Prize offer substantial cash prizes. Plus, winning or even being a finalist can boost your credibility and open doors to further investment. 11. Trade credit, building strong supplier relationships. Trade credit is when suppliers allow you to buy now and pay later. It's a great way to manage your cash flow and build strong relationships with your suppliers. To make the most of trade credit, negotiate favorable terms. For example, try to extend the payment period or get a discount for early payment. A study by PayStream Advisors found that 74% of businesses receive some form of trade credit from their suppliers. Having good relationships with your suppliers can also lead to other benefits, like better pricing and priority service. Be sure to communicate openly and pay on time to maintain trust.
12. Royalty financing. Future earnings for immediate funds.
Royalty financing involves selling a percentage of your future revenue in exchange for immediate funding. It's a flexible option that grows with your business. This type of financing is often used by companies with strong revenue potential but who want to avoid traditional debt or equity financing.
According to a report by IBISWorld, the royalty and licensing industry generates over $10 billion in revenue annually.
A key strategy is to carefully negotiate the terms of the royalty agreement. Make sure the percentage of revenue you're giving up is manageable and that the duration of the agreement aligns with your business goals. This way, you can secure the funding you need without compromising your future growth.
13. Community Development Financial Institutions, CDFIs, support for underserved areas.
CDFIs provide financial services to underserved markets.
They offer loans, investments, and financial education to help businesses thrive. These institutions are a lifeline for businesses in low-income communities.
One key strategy is to approach a CDFI that specializes in your industry. For example, if you're in agriculture, look for a CDFI with experience in that field.
According to the U.S. Department of the Treasury, CDFIs have provided over $38 billion in loans and investments since their inception.
CDFIs also offer more than just money.
They provide business mentoring and training to ensure you succeed.
A study by the Opportunity Finance Network found that businesses financed by CDFIs had a survival rate of 75%, significantly higher than the national average.
14. Equity crowdfunding, turning fans into shareholders.
Equity crowdfunding allows you to raise money by selling shares of your company to the public. It's a way to turn your fans into shareholders and raise significant capital. Platforms like Seed Invest and Crowdcube make it easy to reach a broad audience.
To succeed, craft a compelling pitch that highlights your business potential. Share your vision and growth plans.
Transparency is key. Potential investors need to trust you.
According to the Cambridge Center for Alternative Finance, global equity crowdfunding volumes reached $10 billion in 2020.
One interesting fact: businesses that engage actively with their investors tend to perform better. Keep your shareholders informed and involved. It not only boosts confidence but also can lead to more investment down the line.
5. Bootstrap with purpose, creative self-financing strategies.
Bootstrapping is all about using your own resources to fund your business. It's challenging but gives you complete control. Many successful companies, like Spanx and GoPro, started this way. Start by cutting unnecessary expenses and maximizing your revenue.
Offer pre-orders or discounts for upfront payments.
This can provide immediate cash flow. According to a study by CB Insights, 29% of startups fail because they run out of cash, so managing your funds wisely is crucial. Another strategy is to reinvest your profits back into the business. This creates a cycle of growth and sustainability. It's hard work, but the rewards are worth it. As Reid Hoffman, co-founder of LinkedIn, said, "An entrepreneur is someone who will jump off a cliff and assemble an airplane on the way down."
16. Venture debt, debt financing for high-growth startups.
Venture debt is a form of debt financing for startups that are already backed by venture capital. It provides additional capital without diluting equity. This is particularly useful for high-growth startups needing funds to scale. One strategy is to use venture debt for specific growth initiatives, like expanding your team or entering new markets.
According to PitchBook, venture debt deals in the U.S. reached $25 billion in 2020.
It's essential to partner with lenders who understand your industry and growth potential. They can offer valuable insights and flexibility.
Just ensure you have a clear plan for repayment.
Venture debt can be a powerful tool, but it needs to be used wisely.
17. Bartering and trade, swapping services to save cash.
Bartering involves exchanging goods or services without money. It's an ancient practice that still holds value today. For small businesses, bartering can be a creative way to access needed resources while conserving cash. Join barter networks like iTex or BizX. These platforms connect you with other businesses looking to trade.
According to the International Reciprocal Trade Association, The modern trade and barter industry is valued at $12 billion annually.
A good strategy is to list your excess inventory or underutilized services.
Trade them for something your business needs.
For instance, if you're a graphic designer, you could trade design services for marketing assistance. It's a win-win situation that helps both parties.
18 revenue sharing agreements, partners in profit.
Revenue sharing agreements involve partnering with investors who receive a percentage of your future revenue. It's a flexible financing option that aligns your success with your investors. This method is particularly useful for businesses with predictable revenue streams. To make the most of revenue sharing, negotiate terms that are fair and sustainable.
According to a report by Allied Market Research, the global revenue-based financing market is expected to reach $42 billion by 2027.
A great example is the partnership between musicians and record labels, where artists receive upfront funding in exchange for a share of their future earnings. Apply this model to your business.